Welcome to the channel. Here, we provide clear, actionable insights into the complex world of tax and accounting to help your business thrive.
All right, let's get right into it. We're talking about a brand new IRS rule today. And honestly, it could be a complete game changer for any farmer out there thinking about retirement.
So picture this. You've spent your entire life, decades, building this legacy, your farm. And now you're thinking about selling. I mean, that is one of the biggest financial decisions anyone can ever make. But, and there's a big but, with that decision comes a pretty major challenge.
See, when you sell, all that value you've worked so hard to build up over the years, it all hits at once as a massive capital gain in a single year. And the tax bill that comes with it, whoa, it can be absolutely staggering. Just imagine getting a bill for $300,000, or hey, maybe even more, and it's due right now, all at once. That's a financial shockwave that can throw a serious wrench into your retirement plans before they even get started. But thankfully, a new law is here to change that.
So, what happened was, Congress actually recognized this was a huge problem, so they passed the Agricultural Preservation and Retirement Act, and tucked inside that act is a little provision that was designed for one thing, to give farmers some much-needed breathing room. And that lifeline? It's called Section 1062 of the tax code. And let me tell you, this thing is a real game changer for qualified farmers who are selling their property. The goal here is super simple. Stop that one single massive tax hit.
Okay, so how does it work? It's actually pretty straightforward. Instead of having to pay 100% of that tax bill all at once, Section 1062 lets you break it up into 4 equal annual payments. I mean, that makes managing your cash flow way, way easier after a big sale like that. Sounds perfect, right? Well, there was a catch, a hidden one.
Right, so as soon as this law hit the books, tax pros everywhere started raising their hands. They spotted a major conflict. Basically, a trap that was already hidden in the tax code, one that could have made this whole new 4-year plan, well, totally useless.
So, what was the problem? It all had to do with the old, existing rules for estimated taxes. You know, those are the payments that a lot of people, especially farmers, have to make every quarter during the year just to keep up with their tax bill. And here's where things get messy. To avoid getting hit with penalties, the old rule says you generally have to pay at least 90% of your current year's tax bill through those estimated payments. You see where this is going, right?
Yeah, it's a total contradiction. The new plan is all like, hey, pay your bill over 4 years. But the old rule is sitting there saying, nope, you better pay 90% of that tax this year or you're going to get penalized. You literally can't do both at the same time.
And that is the trap. You could sign up for the 4-year plan, but you'd still get slapped with a huge penalty unless you coughed up 90% of the cash up front anyway. It totally defeated the whole point of the new law. But thankfully, the IRS stepped in to fix it. What they did was issue something called an IRS Notice. This one is Notice 2026-3, and its whole job was to fix this mess and make sure the new law could actually work the way Congress wanted it to.
And you know what? They were super direct about it. They actually said, in their own words, that forcing this huge estimated payment was, and I'm quoting here, contrary to the purpose of the Section 1062 election. So yeah, they got it. They saw the problem loud and clear.
So how'd they fix it? With something really simple but incredibly powerful. They just announced that they are waiving the penalty. That's it. No more underpayment penalty for farmers who use this new installment plan the right way.
The whole fix really boils down to one magic number, 75%. The IRS notice basically says that when you're figuring out your estimated tax payments for the year, you get to just ignore 75% of the tax that came from the sale. Just pretend it's not there.
So what does that mean for you? It means in the year you sell the farm, your estimated payments only have to cover your normal income tax plus that first 25% piece of the sale tax. The other 3 payments, they don't even enter the calculation. And you won't get penalized. Just like that. The trap is gone.
Okay, so this is obviously fantastic news, right? But the big question is, how do you know if you can actually use this? Well, there are 2 really specific definitions you have to meet.
First up, you have to be a qualified farmer. Now, the law defines this as someone who is actively engaged in farming. And I gotta stress, this is a technical definition. It's not just a casual thing. You have to meet a very specific legal standard.
Okay, second thing, the sale itself has to involve qualified farmland property. This one's got 2 parts. First, the property had to be used for farming for most of the last 10 years. And then, and this part is absolutely critical, you have to put it under a legally binding restriction, it's called a covenant, that says it will only be used for farming for the next 10 years.
And finally, there's some paperwork, some steps you just can't miss. You have to formally make the election on your tax return. You have to include a copy of that 10-year farming agreement. And listen, you absolutely must pay each of those 4 installments on time, because if you miss even one, the entire rest of the tax bill comes due right then and there.
So, let's just wrap this all up. We had a really helpful new law designed to ease the tax hit from selling a farm. It had a pretty major flaw, but the IRS stepped up and fixed it. This is, without a doubt, a huge win for any farmer planning out their financial future.
Which really brings us to the most important question, right? For anyone out there who's been putting off selling, maybe for years because of that one giant tax bill hanging over your head, could this be it? Is this the key that finally unlocks your retirement?
Now look, the benefit here is crystal clear, but the rules, they are very specific. Getting those definitions of qualified farmer and qualified farmland right, plus that legal covenant thing, it's not simple stuff. This is definitely not a do-it-yourself situation. So if you're listening and thinking, hey, this might be for me, the absolute most important thing you can do next is talk to a tax professional who really gets agricultural law.